Hi there, I'm John Stewart, and welcome to Last Call for the last day of April, the 30th. Grant Walker will have heads up for you on Friday, the 1st of May, from 10 o'clock. In news from Parliament, health and safety so-called dickhead bureaucrats have come under fire from a government MP at a select committee. The comment from senior National MP Chester Burrows came during a briefing on issues facing the meat and wool industry from Beef and Lamb New Zealand executives. Mr Burrows, who's been MP for Wanganui since 2005 and who's also currently Deputy Speaker, told the Select Committee there are too many bullshit rules being put forward by health and safety officials. The questions of the accident rate among quad bikes was raised, and Beef and Lamb Chairman James Parsons told MPs new rules being proposed are too rigid and in some cases could even reduce safety. One proposal is to allow no passengers on quad bikes at all. Mr Parsons told MPs that often, for example at Beef and Lamb New Zealand's own field days, more experienced bike riders doubled the less experienced. MPs were told an outright ban on allowing passengers would lead to less experienced quad bike riders riding on their own and probably increase the number of accidents. Beef and Lamb is talking with other farm groups, such as Dairy New Zealand and Hort New Zealand, about their similar concerns in the area. Mr Burrows told the industry group he had attended many farm accidents before he was a Member of Parliament, and he's aware of the risks on farms. He says those who do not use farm equipment safely should be prosecuted. But he said there's too much bullshit rule-setting going on. Mr Burrows said, "If I can help you in any way I can in dealing with the dickhead bureaucrats who work in health and safety, I don't know where they've been working, but it's not in a farm or a factory. It would be a growing area of concern," he continued, in all our electorate offices at the moment about the regulations coming out of health and safety at the moment. I would encourage you and your members on a case-by-case basis to go to your MP and kick the shit out of each issue. It is absolute bullshit. And that colourful story from Rob Hosking. In business news, Chinese government-owned Waste Management is buying the balance of Living Earth for $8.8 million. The Overseas Investment Office earlier approved an acquisition for Waste Management's parent company, Beijing Capital Group Company, to take over Trans-Pacific Industries Group Finance New Zealand in 2014. This included 50% of the shares in Living Earth, an organic waste recycling company. Waste Management is now acquiring the remaining 50% of the shares. It told the OIO the purchase will create efficiencies for Living Earth as a wholly owned subsidiary. The acquisition involves purchase of a leasehold interest in 12 hectares on Pukitutu Island and a leasehold interest in 7 hectares in Metro Place, Bromley, Christchurch. Chinese investors have also acquired Whatuwhiwhi Top 10 Holiday Park for $3.8 million, with plans to develop it in conjunction with their adjoining Carrington Resort. The OIO approved the acquisition for the 2.5-hectare freehold land purchase. And that story from Chris Hutching.
To the OCR, the Reserve Bank has made its strongest signal yet that a cut to the official cash rate is likely, abandoning both its previous line that a period of stability for the official cash rate is needed and that the next move could be up or down. Governor Graham Wheeler indicated a cut could be coming. As expected, the Reserve Bank kept the OCR at 3.5%, where it's been since last July, and which it still says is stimulatory. But annual inflation at 0.1% and expected to go lower, plus a stubbornly high exchange rate, are propelling the central bank toward an interest rate cut. Mr Wheeler says in his latest OCR review, the bank expects to keep monetary policy stimulatory and is not currently considering any increase in interest rates. It would be appropriate to lower the OCR if demand weakens and wage and price setting outcomes settle at levels lower than is consistent with the inflation target. Unlike previous rate cuts, the move is not being driven by an economic slowdown. While lower dairy incomes, the lingering effect of drought, the government's fiscal consolidation program and the high exchange rate are weighing on the outlook for growth, the Reserve Bank says annual GDP growth is still running at around 3%, and this is expected to continue. Offsetting those negative factors are low interest rates, high net immigration and construction activity, along with the fall in global fuel prices. And then there are those high Auckland house prices the Reserve Bank has been concerned about. The vexed issue only got a passing mention in today's statement. The Reserve Bank is not, though, going to cut interest rates at a time of 20% annual increase in house prices in the country's largest city. At least it's not going to do so unless it can be reasonably confident of not throwing petrol on that house price bonfire. That means the Reserve Bank's next big event, the biannual financial stability statement due in 13 days' time, is assuming ever larger significance. Restrictions on lending to property investors, most likely via some kind of larger capital requirement imposed on lending institutions, have been discussed over the past 18 months by RBNZ officials. Any such restrictions are most likely to be announced at the time of the Financial Stability Report. Such measures are concerned with the overall stability of the country's financial system rather than, as with OCR announcements, inflation.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
I'm Neville Gibson and you're listening to NBR Radio's Weekly Media Watch. I'm talking to Victoria Young, who's filling in for Campbell Gibson. Victoria, MediaWorks is still in the news. What's going on there?
Well, another interesting development this week. Private equity firm Oaktree Capital has now got almost 78% stake in the owner of TV3, Radio Live and those other media brands. What it's done is it's bought out Westpac New Zealand and the Royal Bank of Scotland, who had partially funded private equity firm Iron Bridge's 2007 purchase of the company, and they became shareholders when they converted their debt into equity following the 2003 receivership of MediaWorks.
Well, what can you tell me about Oaktree?
Well, it's a LA-based firm which, according to MediaWorks Chief Executive Mark Weldon, who released a statement, is an experienced long-term investor into media business. This firm has also invested into Nine Entertainment in Australia a few years ago.
So what's the shareholder lineup now?
So the bank's exit means that MediaWorks has just three shareholders, obviously Oaktree with the majority, TPG, which has about 16%, and Bain Capital subsidiary Min Wan Light APAC, which has about 6%.
So what do you know about their intentions? Is there any news on that?
Well, it's really quite a wait and see to see what Oaktree are going to do with this majority stake. It's not a great surprise the banks would have wanted to get out, but the interesting thing here is we're seeing that an experienced media investor come in, who Mark Weldon is touting as long-term, and that really conflicts with what we've seen of MediaWorks' strategy. NBR's coverage has been quite extensive of this. MediaWorks strategy, particularly in the TV department, looks like it's being dressed up to sell. We've seen this in the cheap and cheerful reality TV strategy and other indications. For example, the recent accounts for MediaWorks show board members will get a bonus if the company can be floated or sold. It's also worth watching what's happening over the ditch because Weldon's mentioned Nine in its media release, but it's worth mentioning that just a few weeks ago, Oaktree sold off half its stake in Nine Entertainment, and this was just before Nine offloaded its events business to, which is called Nine Live, to an Asian private equity firm. And just to make things more interesting, MediaWorks has a partnership with this events arm, Nine Live. So there are plenty of developments here, and it's worth watching what's going on across the Tasman as well.
I'm sure we will keep looking for news on MediaWorks, but moving across to magazines, what's been going on at Trends magazine?
Well, the publisher of the architecture magazine, David Johnson, has revealed to NBR Online that the publication has lost more than half its staff since Callaghan Innovation revealed in December it suspended a grant and the company was being referred to the SFO. It had about 70 staff and is now down to about 35. The Callaghan Innovation grant was to fund the publisher for about $400,000 for sort of new technology.
And what's that about Callaghan's involvement? What are they saying about that?
Well, Mr. Johnson has sort of come back quite fired up, and he says Callaghan has been wrong with every fact in saying that it had been suspended in December. He says that in any event, Trends hadn't been paid since June, and he's actually gone out and said Callaghan Innovation, who granted them this money, is quite a sloppy organisation, which is quite interesting.
Well, I suppose David's always having an argument with the government on some things. Yeah. But moving over to the video business, what's been happening at Video Easy?
Well, the head office for the movie rental chain has been moved into liquidation, which has forced an assignment of the master contract back to Australian owners. Basically, the head office in New Zealand here fell behind on its licensing fees and so went into liquidation. According to the Grant Thornton liquidator Greg Sheriff, the Australian arm became concerned about not having received information from the New Zealand directors, which actually saw it take court action. Now, that court action on Wednesday was subsequently adjourned because the liquidators agreed basically to give the Aussies back control of the Video Easy franchises. As for the liquidation itself of the head office, ANZ had a general security agreement and there's some trade creditors, but it looks like it won't be more than $1 million owing.
Well, Video Easy is a pretty well-known brand around the country. What does all this mean for the individual franchisees?
Yes, well, both the liquidator and the Australian chief executive, Paul Unicki, they're saying that it's going to be business as usual for customers and the individual franchisees. There's still 70 of them across New Zealand, which actually came as a surprise to me because I don't pop down to the video store that often anymore.
Well, the one in Devonport closed recently, and there's still another one from another brand. Thanks very much, Victoria. You've been listening to Media Watch.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
Hi there, I'm John Stewart and welcome to Last Call for the last day of April, the 30th. Grant Walker will have heads up for you on Friday, the 1st of May from 10 o'clock. In transport news, ratepayers and businesses are being hit in the pocket to fund Auckland Council's $10 billion transport scheme. Mayor Len Brown has proposed an extra $2 a week for residential ratepayers and $3 a week for businesses on top of their rates. Mr Brown says the fixed levy is a temporary solution, while the council continues talks with the government on motorway tolls to fund the extra $12 billion needed to fund the full transport network. The levy will raise $500 million over 3 years. It's been calculated at an average of $99 a year for residential ratepayers and $159 for businesses. The council will leave the uniform annual general charge at $385 and slow down the reduction in the business differential to 0.5% a year to limit the impact on homeowners. The government has repeatedly said it will not consider motorway tolls. It would require a change of legislation and take a number of years to do. But Mr Brown says the council will push on with lobbying the Transport Minister over the issue. A recent council poll by Colmar Brunton of 5,000 Aucklanders showed 57% favoured motorway tolls to find the $12 billion shortfall. Councillor Cathy Casey has lambasted her fellow councillors, saying the poll was a push poll and came up with the answers council wanted. She says it is not a mandate for us to go ahead with lobbying on motorway tolls. The only way a mandate can be established is by a referendum of all ratepayers, not a landline phone poll. How many people have landlines these days? North Shore Councillor George Wood, backing up Councillor Casey, says most West Aucklanders have made it clear they support a fuel tax. He says the council has to look at whether ratepayers really want motorway tolls. And that story from Sally Lindsay. In news of a loss to the business world, Greg Kay was an exceptionally talented and highly energetic man who contributed greatly to the business world, his friends and colleagues say. The well-regarded businessman died of a heart attack in the aftermath of the devastating 7.8 magnitude shake that rocked Nepal last Saturday. Mr. Kay, the son of the former Mayor of Auckland, the late Colin Kay, was on a trekking trip with a group of 12, led by his old King's College friend Peter Hillary, son of Sir Edmund. The group were in Nepal to raise money for a new water system at the northeastern village of Lukla and had been on their way to the Everest Base Camp before being forced to turn back due to the earthquake. The 61-year-old died in his sleep on Sunday at a hotel in the village of Tengboche, where the group was staying the night. Mr. Kay had a high-flying business career. His many colours included Chief Executive at Wrightson and Coal Corporation of New Zealand, which is now Solid Energy, and a Director at Telecom, TransAlta New Zealand and Pacific Road Corporate Finance. He was also one of the founding directors of the New Zealand Council for Infrastructure Development. Sir Roderick Dean, who knew Mr. Kay as a friend and colleague for a great many years, says he was creative, highly intelligent and hard-working. Sir Roderick says he was splendid to work with, full of life and energy. He was a generous contributor to anything he took on. It was a huge shock that somebody who had so much left to offer has left us. The two worked closely together over the years, including when Sir Roderick was chairman of Pacific Road and carrying out a spending review in 2010 for the New Zealand Defence Force. Sir Roderick says he was very good at spotting opportunities and knew how to add value to a company. That was his creative mind. He was tailor-made for the type of work he did. Sir Roderick says the man will be sorely missed by his family, wide circle of friends and the business community. And that story from Callida Smiley.
People. The former All Black halfback Mark Sharky Robinson, who recently denied he's bankrupt, put $70,000 into a failed lifestyle property development after former Health Pizza franchisee Matt Blomfield encouraged him to buy into it. NBR Radio has reported a Mark Darren Robinson, born in 1975, was in February bankrupted by the High Court at Wellington on an application by ANZ. The former All Black, who shares the same full name and year of birth, denies it's him. Only one Mark Darren Robinson is listed on New Zealand Companies Office records, which a lawyer confirms is the ex-All Black known as Sharky. But it now emerges the same Mark Robinson was also a director and shareholder of a now struck-off company called MDJ Properties. The company's other director was Matt Blomfield, who last year took defamation proceedings against whale oil blogger Cameron Slater. A 2011 High Court judgment shows both Mr. Robinson and the company were defendants in a dispute with Mangawhai Developments, which went into receivership in 2009, owing more than $9.1 million to secured creditor Matrix Custodian. Mr. Blomfield was also one of two sales agents engaged for 6 months to market the development. He was to be paid a $10,000 monthly retainer plus $5,000 for every sale, so long as he averaged 2 a month. Mangawhai Developments' 47-lot farm park-style subdivision was located at Devich Road in the popular lifestyle area of Mangawhai, just over 100k north of Auckland. Mr. Robinson entered 2 agreements personally and another 5 through the company, transferring $20,000 to a trust account in June 2005 and another $50,000 in August of the same year. Justice Peter Woodhouse says in his judgment, Mr. Robinson and Mr. Blomfield were at school together, and in 2005, Mr. Robinson was contacted by the latter about the development. He was in the UK at the time, having shifted there in 2004 to play rugby union for Northampton, but Mr. Blomfield encouraged him to buy into it. Mr. Robinson's undisputed evidence was that he invested in the development purely on the basis of what Mr. Blomfield told him. His evidence says Matt was dealing with these matters on my behalf. It was initially intended that Matt and I would be joint shareholders in the company. After the sale and purchase agreements had to be cancelled, the entire shareholding of the company was transferred to me. The various lots available as part of the development were priced between $155,000 and $300,000. For more on this, go to nbr.co.nz.
NBR Radio with Crombie Lockwood. Insurance intelligence is business intelligence. Talk to Crombie Lockwood.
How people get their news from websites is undergoing a major change. Mobile devices such as smartphones are taking over from desktop computers. In his Editor's Insight today, Neville Gibson looks at a new State of the News Media report. Neville, what is this report and what's it saying?
The American Pew Research Centre's State of the News Media Report is considered the most authoritative in the industry. It annually surveys all aspects of the news business and reports trends that are likely to happen here in New Zealand and elsewhere. The headline news from the report this year is that mobile devices are the top method of access at 39 of the top 50 digital news websites, and this means that desktop computers are going out of fashion. But Pew says that most of the desktop visitors stay a little bit longer, and the average visit to all sites is just 3 minutes. Incidentally, half of adult Americans now get their news about politics and government from Facebook feeds. So that's pretty interesting too.
Yeah, indeed it is. So what's happening with television?
Well, the interesting trend here that they've picked up is that the big networks and local television news are making a bit of a comeback. But it's been at the expense of cable news, and these are the 24/7 channels. They're down overall 8%. That includes Fox News, which didn't fall as much, MSNBC and CNN. But the biggest rise for local TV news occurs at early morning TV news is taking off, and so are midday bulletins. I'm not sure how they, while the network evening shows are up by a combined average viewership of roughly 24 million. So that's pretty promising from the free-to-air broadcasters' point of view.
It is. It's going against all the trends that people are predicting, isn't it? So with television, does this mean radio is also making a comeback?
Yes, it is, mainly because digital and mobile developments are very good for audio. In fact, podcast listening's on the rise, which I might add is good news for listeners to NBR radio. But in America, the main beneficiary is public radio. It says it's had a 41% increase in downloads in just 1 year.
That's pretty healthy.
That's NPR. That's a big network, but it's run on a local basis. Also, these mobile devices allow you to listen to online radio when you're driving around, and people are listening less on desktop computers. So all in all, it means that online radio listening is really picking up strongly.
Just like we assume subscribers will be listening to NBR radio while they're on the move.
As long as you can learn how to plug your smartphone into your car radio slot.
Whoops, I think I might have to call
Well, you
a
could
stop
listen
there.
with earphones, I guess.
Indeed,
That's quite a popular way of doing it.
So what's the report say about newspapers and magazines?
Well, the Pew Centre, let's face it, is mainly about newspapers and magazines and print. It is really the gold standard for any kind of research in this area. But sadly, newspapers are still losing ground in print, but they're gaining online. Daily and Sunday newspaper circulations in the United States continue to drop. They're down 3% in the past year, and they've fallen nearly 20% over the past decade. But newspaper readers are quite loyal. They're creatures of habit, and more than half of them read print only, while just 5% of them read exclusively on the mobile devices, where you have apps to read the newspapers by flicking through the pages. Magazines that are news-oriented, like the news weeklies, are holding up better than the magazine category as a whole. They rose 1% in newsstands, while newsstand sales only make up a small percentage of total magazine sales, about 7%. But they're considered important because they're a bit of a guide to interest, because they aren't affected by cheap subscription offers and promotions, and magazines in America literally sell for well below their cost. But if you buy it on a newsstand, they measure that as quite a good sign of interest. And the big gainers among the titles in the news area are New York Magazine, The Atlantic and Rolling Stone, all of which are available here, I think, while The Week, which is really just a summary type paper, not available here, and the New Republic had the biggest drops.
So what are the most popular news websites in America?
Well, this is an interesting one too, because Americans actually have 5 British online news websites from newspapers in their top 25. Mail Online is third behind USA Today and the New York Times. But of course, Mail Online is quite a popular one, isn't it?
Yeah.
Even in New Zealand, it probably rates very highly.
Mm.
And The Guardian's also popular. That comes in 5th, with the Washington Post coming in 4th. I must say that the Wall Street Journal, which is probably pretty big among New Zealand business readers at least, is not included in this research because it's not classified as a general newspaper. Another feature of these large newspaper sites is that their online traffic far exceeds their print circulation. The standout, of course, is the New York Times. It has a weekday circulation around about 650,000, but its monthly unique visits are around 54 million. It's a paid website if you watch more than 10 articles, and so it has 1.4 million subscribers. They actually pay the New York Times more than all the print subscribers put together. And finally, just the popular news websites which don't belong to newspapers. The biggest one by far is Yahoo ABC News. That's a clear leader with 130 million. That's pretty much 3 times what the, well, not quite 3 times, but it's much more than the New York Times. It has 130 million. That was in the month of January. The next most popular of those are CNN, NBC News, and the Huffington Post, which is neither a TV channel nor a newspaper.
Yeah, an interesting peek into the future there, Neville, and maybe these figures are a bit more positive than a lot of people in the newspaper industry in particular would be accepting.
Well, Pew are always looking for positive news, and while there's a lot of material there, they do look for the most popular and positive signs in the industry.
Right. Okay, well, look, we'll wrap it up there, but thanks very much for your editor's insight today, Neville.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
Hi there, I'm John Stewart, and welcome to Last Call for the last day of April, the 30th. Grant Walker will have heads up for you on Friday, the 1st of May, from 10 o'clock. In company board news, Simon Allen has been elected chairman of New Zealand Refining, which operates the Marsden Point refinery, replacing David Jackson, who stepped down at Wednesday's annual meeting. Shareholders on Wednesday ratified Mr Allen's appointment to the board in December, and prior to the meeting he was appointed chair by his fellow directors. The company says the board believes Simon's considerable business experience, proven leadership and strategic insight will complement that of his fellow directors. Mr Allen also chairs the Financial Markets Authority and Crown Fibre Holdings and is a director of Auckland Council Investments. In business news, SPI Property Fund directors Murray Alcock and Alistair Knight have each been fined $25,300 for failing to file audited financial statements for several years. The Financial Markets Authority said in a statement, Alcock and Knight pleaded guilty to breaching the Financial Reporting Act last November by not filing statements to the Registrar of Companies for the 2011, 12 and 13 years. The pair faced a maximum penalty of $100,000. FMA Director of Enforcement and Investigations, Belinda Moffat, says, "We expect companies that offer securities to file their financial statements in a timely way to enable investors to make informed decisions about their investments." The court's decision sends a further strong signal to companies raising funds that the FMA will take enforcement action when companies persistently fail to meet their obligations. In November, Alcock and Knight were ordered to repay $1.08 million to investors and banned from heading up any company that raises money from the public for 5 years, after agreeing to enforceable undertakings from the FMA. In industrial relations news, a veteran employment lawyer says the public backlash over zero-hour contracts has been exaggerated and most people wouldn't have an opinion on the matter. This comes after McDonald's and Unite Union again clashed over the use of zero-hour contracts. This week, during negotiations with Unite Union, McDonald's offered 80% security of hours for staff and up to 32 capped hours worked, based on an average of the previous 12 weeks. But Unite Union Director Mike Treen said while the offer was a good start, it was still not good enough, and McDonald's needed to come up with a plan for securing shifts. A McDonald's spokeswoman slammed the union for not negotiating in good faith, while Unite said the fast food company walked out of the negotiations in a huff and refused to engage in a meaningful way. Despite the strong union response and threat of strike action, Peter Cullen, a partner at employment law firm Cullen, says the public backlash over zero-hour contracts is exaggerated. He says most people in New Zealand, excluding the unions in question, would not even have a view on the issue. He says there's always been a need for zero-hour contracts, particularly in the hospitality industry. Mr. Cullen says, if there's some rugby fixture or some big event on and an employer needs to bring in extra staff, say housemaids for weekend work or restaurant staff for a big overflow crowd, they need casual workers to do that. He says this has been the case for as long as he could remember. But, he says, there are a few elements of the contracts that are objectionable. According to Mr. Cullen, there seem to be cases where employees are called in only to be told they are not needed at the last minute. He says if someone is called in, then the employer ought to honour that and either give them work or give them minimum payment. Contrary to Mr. Cullen's view, however, a majority of polled NBR readers think the fast food giant should bite the bullet and abandon zero-hour contracts. Some 54% of poll participants say McDonald's should completely abandon the zero-hour approach and adopt secure shifts, while 46% say the company should hold its ground and keep zero-hour contracts. And that story from Jason Walls.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
In economics news, an Australian economist says it's time to start reassessing bonds as safe havens, and they're now as risky as stocks, but his claims have come under fire from a macroeconomic market analyst. QUT senior economics lecturer Dr. David Willis says with Australian bond yields and inflation so low, Commonwealth bonds are no longer the safe bet they once were. He says, traditionally, bonds have had a safe and cushioning effect on portfolios when finance crisis and recession hit, as they're a reliable part of a diversified portfolio that also includes shares, corporate bonds and property. He says as the stock market crashes in a crisis and house prices fall, bonds have tended to be positive, but he warns that in the years following the global financial crisis, this has no longer been the case. Dr. Willis says, with bond yields so low and inflation low, there's now a real chance of bonds decreasing in value and a substantial capital loss. This makes bonds a similar risk to stocks, and he says investors should be taking a fresh look at their portfolios. He says the restarting of inflation and higher interest rates would see a capital loss on bonds. TD Securities Chief Asia-Pacific macro strategist Annette Beecher has rubbished Dr. Willis's claims, saying it sounds like he's just discovered what bonds are. Yes, yields are low and inflation is low, but it's all relative. She says investors who are content to have capital returned while earning a positive return will hold on to the bond until maturity, and if the price rises and falls in between, that's irrelevant. She says there is a risk, of course, of holding bonds while interest rates rise, but on most metrics, bonds are rich anyway. She continues, anyone with a fair value model would have the last 2 to 3 years of Australian Commonwealth government bonds and New Zealand government bonds trading well below. She says when rates in Australia normalise, so will bond yields. And that story from Jason Walls. In property news, Auckland Council says it has reservations over a High Court decision which means it has to pay $25 million to leaky building owners. Claims manager Sally Gray says the decision is complex and lengthy and the council will take time to consider an appeal. Justice Murray Gilbert ruled substantially in favour of apartment owners in the Nautilus apartment building case. The lawyer who took the suit, Tim Rainey, says Auckland Council will be left with the bill as other defendants in the case have been relieved of liability or are unable to pay. The 12-level building has 140 units, cost $35 million and was constructed between 2002 and 2004. The lawyer says owners will get about $22.5 million for repairs, plus about $2.5 million in damages, and he anticipates repairs to start by the end of this year. The owners who lived in their units while it was leaky will get a payout of $15,000, while those that owned units but didn't live in them were awarded $10,000. He says owners cried tears of joy when told of the news. The body corporate had not received a settlement offer before trial, but after the 6-week hearing, the council made an offer. The owners refused. Mr. Rainey says, I can't tell you what the offer was, but I can tell you if you put the settlement offer alongside the judgment, you'd have to have rocks in your head to have accepted it. It's extraordinarily disappointing the owners were forced to go to trial and incur all the cost, expense and delay that is part and parcel of it. But now the council has been forced to face up to the consequences of its inaction. And that story from Victoria Young.
To the dairy industry, following what is understood to have been an extraordinary meeting of the board yesterday, Fonterra has reduced its forecast farmgate milk price from $4.70 a kilogram per milk solid to $4.50 for this season. Combined with estimated dividend range of 20 to 30 cents, this amounts to a forecast cash payout of $4.70 to $4.80 for the current season. Under the Dairy Industry Restructuring Act 2001, the board had not been expected to review the payout until late May, so the announcement has taken most by surprise. In a statement, Fonterra Chairman John Wilson says the reduction reflected the continuing and significant volatility in international dairy commodity prices caused by oversupply in the market. He said, we have confidence in the long-term fundamentals of international dairy demand. However, the market is not yet rebalanced and GDT prices for products that inform our farmgate milk price have fallen 23% since February. This reduction will impact cash flows for our farmers, who will need to continue exercising caution with on-farm budgets. Our farmers are already managing tight cash flows. Although this reduction is not the news that anyone wants, it's important we keep our farmers updated given the significant market uncertainty. Given the reduced milk price forecast, we're also lowering the advance rate of scheduled monthly payments to our farmers. Mr. Wilson says we will continue to keep our farmers updated as the season progresses. Chief Executive Teo Spearing said geopolitical unrest in places such as Russia, the Middle East and North Africa is impacting global dairy demand. Mr. Spearing says remote as they are, events such as the flow of refugees from Libya to Europe come together with factors like lower oil prices to soften dairy demand.
NBR Radio with GE Capital, championing mid-market businesses in New Zealand.
Hi there, I'm John Stewart and welcome to Last Call for the last day of April the 30th. Grant Walker will have heads up for you on Friday the 1st of May from 10 o'clock.
Hello, I'm Victoria Young for NBR Radio. I'm here with our primary industries reporter Jamie Ball to discuss the unexpected Fonterra announcement that it's reduced its forecast farmgate milk price from $4.70 a kilo of milk solids to $4.50 this season. So, Jamie, was this reduction expected today?
No, it certainly wasn't expected today. They had a review late March. I think March 25th, Fonterra last had its review, and then there's a further review expected at the end of May. So that's only a 2-month window. So this has caught many, including myself, by complete surprise. There are a number of reasons Fonterra say they have fed into it, but how the global dairy trade landscape has changed significantly in the last 4 weeks since the previous review is hard to determine.
So what do you think the key reasons that really are driving this are?
That's a good question. I'm trying to get to the bottom of it myself. The news has only come out in the last few hours. We've talked to a few analysts and consultants and economists. Essentially, nothing major has changed on the international scene in terms of the fundamentals of demand and supply. Nothing major has changed in the last 4 weeks. Probably nervousness has kicked in. Global dairy trade prices continue to drop. We thought they'd bottomed out in December. The mood going into Christmas was very buoyant in the global in the dairy trade, not just here but overseas as well. That the worst was over, and we were going to see a steady lift from here on in. But that script really has not been lived out at all by the reality. I think sometime around February they started to plateau again and then drop. We are now back to our prices in December. So I can only assume that the Fonterra board just reckoned another 4 weeks is too long to go before updating their farmers on the forecast price. That the steady drops in the last few global dairy trades, which come out every 2 weeks, and in the key commodities of whole milk powder and skim milk powder, which account for the vast majority of Fonterra's products, that it just would be simply too long to wait until late May. In late May, though, also with that announcement will be their first forecast announcement for next season. So it really is a very, very big announcement that we're due in 4 weeks.
So what does this mean for the farmers?
Well, essentially another kick in the guts for what's been a very testing year. But that has to be said, and anyone who has farmed, I have a background in farming originally, and a lot of people will have at some stage in New Zealand have some sort of interaction with farming. If you know farmers, you know more than anything they're very resilient, and they take the long-term picture. There's no, or very, very little getting in quick and getting out quick and making quick bucks. It just doesn't exist in agriculture. Farmers have been around the block. They know there's good years and bad years. We have to remember, even just as readers or as commentators, as journalists, whatever else, that you have to take the rough with the smooth. Last season was a record payout of $8.40. It really was phenomenal. This is really a terrible year, and next year looks like it'll be very challenging, to say the least. But you really do have to take the long view. Farmers will adapt. They will have seen this coming. The forecasts have been steadily poor for the last 6 months, and they're expecting another poor forecast next month. It's just that a further forecast has arrived in April. That is largely telling them what they already knew, but greatly feared, that prices will continue to go south. Next season had been up to perhaps 3-4 months ago. The great white hope was next season that things would rebound, but the script is just not living up to that hope. It's not looking very favourable at all for next season. When you have the knock-on delayed effects of payout trickling in from this season, it's going to be very, very, very challenging. I think this time next year we might be looking at an awful lot of dairy farmers who would have gone to the wall. But this is not going to be news to them. At the same time, they're astute businessmen. They know what they're doing. They realise that this is we are largely price takers when it comes to the global dairy market. And they have been adapting over the last 6 to 9 months, and they will continue to adapt.
I can see you've discussed this with a few analysts as well this morning once the announcement was made, in that they're saying they're quite disappointed. Can you flesh out what analysts think about this?
Yeah, it is very early days. It's only broken in the last few hours. The disappointment I sense is more so in the timing. It's the effects that it might have had, will have on dairy farmers who are, remember, it's a cooperative and they own Fonterra. I can only surmise that the disappointment is in, much like the points I mentioned a little earlier, is, well, what did Fonterra know? What have they discussed in the last 24 hours that they were not aware of 4 weeks ago when they had the last review? I think it was March 25th. There's something ironic in it too, in the sense that volatility is the key word. If you've been following dairy markets for the last 2-3 years in particular, but you could argue for the last 10, that the V word keeps coming up over and over again. So if you're operating in such a volatile market, it doesn't really help to throw in such a curveball every so often, like this morning, like such an unannounced review, when there was a review, like I said, just 4 or 5 weeks ago, and there's another one due in 4 or 5 weeks from now. It doesn't do much to abate that volatility or to inject any sort of security or stability. And that was immediately felt with the drop in the dollar, as most commentators or most readers would be aware. It just doesn't do much to help that volatile situation, that sense of New Zealand once again reacting rather than acting to what is going on in the international dairy market. So perhaps that disappointment comes from that aspect.
Well, thanks for that, Jamie. I guess we'll be looking forward to see what happens in the next announcement in 4 or 5 weeks' time.
Yeah, thank you, Victoria.
Great. That was Primary Industries reporter Jamie Ball speaking on NBR Radio.
NBR. Read and listen to NBR online for just $90 a year. Visit www.nbr.co.nz/subscribe.
In news from Ports of Auckland. Ports of Auckland says it will build only one wharf extension to appease the council and protesters. The second extension will not be built until after the decisions in the year-long future port study are known. The ports company says that if the study finds no port expansion is needed, the wharf extension will be demolished. Ports Company Chairman Graham Hawkins, in a letter to ACIL Chief Executive Gary Swift and Council Chief Executive Stephen Town, says if extra berth space is not built, longer cruise ships will have to be turned away. Mr Hawkins says this will cost the Auckland economy $1.8 million for every ship turned away. He says turning cruise ships away is a decision the port cannot make itself. Mr Hawkins says other options had been considered, including docking cruise ships at Wynyard Wharf, extending Captain Cook Wharf, rebuilding the area occupied by Marsden Wharf, and using the northern face of Bledisloe Wharf. Mr Hawkins says each option has practical limitations in our assessment, making the wharf extensions the only immediate and affordable option to address the requirement for additional berthage space. He says the compromise will have significant financial consequences for the Ports Company and the Council, both in relation to the construction contract with Brian Perry Civil and the benefits to the city if the second wharf is not built by 2016. The Ports Company has urged the future port study be completed and a response finalised by the end of April next year. And that story from Sally Lindsay. In aviation news, the national airline is today celebrating the 75th anniversary of its first international commercial flight from Auckland to Sydney. The short S-30 flying boat carried just 9 passengers on the April the 30th, 1940 journey that lasted 9 hours until it landed at Rose Bay in Sydney Harbour. Air New Zealand was then known as Teal, or Tasman Empire Airlines, and today's flight, using a Boeing 787-9 Dreamliner, will take just over 2 hours and be dressed up for the occasion. The airline says passengers will be treated to a 1940s-themed menu, a mid-air fashion show of the airline's uniforms through the decades, and other surprises. Later in the day, a separate celebration will be held in Rose Bay. Chief Executive Christopher Luxon says the 75 Years exhibition at Te Papa National Museum in Wellington will transfer to the Auckland War Memorial Museum on November the 20th. He says the exhibition has proved a huge hit so far and has attracted almost 250,000 visitors since it opened last December. The exhibition dates have also been extended and it will remain in Wellington until July the 26th. In addition, 75 passengers who book economy fares over the next 2 days have a chance of winning their fares back in a lucky dip competition. The airline is also holding its In the Bag quizzes on main city and regional services, with contestants choosing between the money, Airpoints dollars, or the bag, a mystery prize. And that story from Neville Gibson. In business news, remote measurement software developer Ike GPS will miss its prospectus revenue targets for the 2015 financial year. But it says that's because sales of its new smartphone application, Spike, are running 3 months behind schedule and are expected to exceed targets. 8 months after listing on the NZX, the company also says it's entertaining interest from US investors. While Ike GPS had no requirement for cash, Chief Executive Glenn Milne said in a statement to the NZX it was attracted to the prospect of having US-based strategic investors on its share register, given the significant business opportunity in that market. A specialist investor relations advisory firm, MKR Group, has been appointed to assist the process and further develop a long-term investor relations program in the US market. Giving guidance on the current financial year, Mr. Milne said the company would make a smaller loss than its prospectus forecast of $5.33 million, although revenue would come in below the forecast of $6.46 million, as he says, primarily due to anticipated sales from its startup smartphone solution falling just outside the March 31st, 2015 financial year end.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
Hi there, I'm John Stewart and welcome to Last Call for the last day of April the 30th. Grant Walker will have heads up for you on Friday the 1st of May from 10 o'clock. In property news, Tamaki Redevelopment Company has yet to register as a social housing provider to receive government subsidies. Until now, the company has primarily promoted itself as an urban rejuvenation authority. On Thursday, Finance Minister Bill English consummated a deal to hand over 2,800 state houses to the company, which has been involved in redevelopment at Tamaki in Auckland. TRC is a joint venture between Auckland Council and the government. As part of the deal, the government will provide a $200 million loan for working capital. The handover is the latest in a series of new arrangements by the government, resulting in local councils taking a much bigger role in social housing. This has already occurred in new house building initiatives in Christchurch, where the City Council is also enthusiastic about managing social housing, with the help of existing government subsidies in the same way Housing New Zealand conducts its social housing. Labour's housing spokesman Phil Twyford was quick to point out the move was risky and TRC was unprepared. He told NBR Radio that Tamaki Redevelopment Company's budget last year was $4 million and it employed about 20 staff. He says the move is driven by government desperation to appear to be doing something decisive about Auckland's housing crisis. Phil Twyford said the move was reckless, placing a massive taxpayer-owned asset and the lives of 8,000 people in the hands of a tiny 3-year-old organisation with no experience of being a landlord. The move comes after the Salvation Army and the Methodist Mission recently ruled themselves out as buyers of state housing stock. Mr. Twyford says it would force TRC to become one of the country's biggest landlords overnight. The company had not previously asked to become a landlord. And that story from Chris Hutching. In dairy industry news, dairy industry commentators say they are surprised and disappointed by Fonterra's announcement on Thursday that it's reduced its forecast farmgate milk price from $4.70 a kilogram of milk solids to $4.50 for this season. Fonterra's farmgate drop amounts to a forecast cash payout of $4.70 to $4.80 for the current season, when the estimated dividend range of 20 to 30 cents is factored in. Fonterra's last milk price review was in late March. Its next was due in late May. A DIRA, Dairy Industry Restructuring Act review, which Fonterra says is still going ahead and one that will announce its opening forecast price for next season. BNZ senior economist Doug Steele says it's a bit surprising both in terms of timing and magnitude. Obviously, the dairy market has been weak. It was possible that the milk price was going to go down, but we thought that if it was going to happen, it would be announced at the end of May. Mr. Steele says it's unusual but not unprecedented for Fonterra to have a milk price review in April. He says, while it wasn't expected when you look at the extreme volatility that's been happening in the market, as displayed through the global dairy trade auction, prices have moved pretty rapidly in this month and the previous 2 months as well, both up and down. Compared to late season, this season is down $6.7 billion in total, including the dividend change, and the revision today is about a $350 million loss for the industry. Mr. Steele says Thursday morning's announcement is also obviously not a good signal for next season. He says, we think dairy prices will remain pretty sluggish and subdued, at least for the next few months, but we do think there are some signs that global production growth is growing. Our current milk price forecast for next season is $6 a kilogram of milk solids, but there's obviously downward risk around that given current pricing and sentiment. And that story from Jamie Ball.
NBR Radio with AUT. AUT Research, benefiting New Zealand. AUT.ac.nz/catalyst.
In mining industry news, Oceana Gold Corporation, which operates the Macraes gold mine in Otago, reported a 58% drop in first quarter profit, with sales down from a year earlier, and announced plans to buy the Waihi gold mine for $101 million US. The Melbourne-based company says net profit fell to $24.5 million US in the 3 months ended March, from $58.9 million US a year earlier. Sales declined 24% to $129.3 million US, and earnings before interest, tax, depreciation and amortization sank 40% to $60.7 million US. The miner announced plans to buy Newmont Mining Corp's Waihi operation for cash plus adjustments. Newmont will keep a 1% net smelter royalty for gold ounces mined from one specific tenement, capped at 300,000 ounces of production. Oceana Gold says the deal is subject to regulatory approvals and due diligence. The transaction will be funded through existing cash and undrawn bank debt. Chief Executive Mick Wilkes says the efficiencies implemented a year ago in New Zealand, along with lower fuel prices and a more favourable exchange rate, have translated into a more robust business with even stronger profit margins. We're also pleased at the prospect of acquiring the Waihi gold mine from Newmont, as we've long believed this high-quality asset strategically complements our existing portfolio. Oceana Gold returned to profit in 2014 after it posted a loss a year earlier, writing down the value of its Macraes goldfield in Otago, which is slated for closure in 2017. In news from the courts, Alex Sweeney, the former boss of Auckland business organisation Heart of the City, has avoided prison, at least for today, after the sentencing judge fell ill. Mr. Sweeney was due to appear in the Auckland District Court today for sentencing after admitting to more than $4 million in tax evasion and fraud and being convicted. He was likely to face jail time, but the sentencing was postponed after Judge Grant Fraser fell ill. Judge David Harvey will instead hear the matter to decide a future date. Last week, Sweeney pleaded guilty to a charge brought by the Serious Fraud Office of dishonestly using documents. He had already admitted in January to charges laid by the IRD covering $1.8 million in unpaid taxes. The IRD also alleges Sweeney owes $1.4 million in penalties and interest. Sweeney was released on bail but was due to appear in the Auckland District Court for sentencing on the SFO charge and 4 IRD charges. The maximum prison term for the SFO charge is 7 years. A judge has previously indicated jail is a likely outcome. Sweeney created fictitious invoices while at the Heart of the City that resulted in payments of more than $2.5 million to accounts controlled by him. SFO Director Julie Reid says the misappropriation increased the cost of the services provided by the organisation and reduced the benefits delivered by it. Sweeney had initially denied the IRD charges last year, but changed his plea after switching lawyers to Murray Gibson. Sweeney also faces civil proceedings by Heart of the City's board, which undertook an independent investigation when the allegations surfaced. Heart of the City is mostly funded by targeted business rates, and its purpose is to promote business in the Auckland CBD. Mr. Sweeney had been at the helm of the Business Association for more than a decade. In 2007, he unsuccessfully ran for mayor of the then Auckland City Council, losing to John Banks. And that story from Hamish McNichol. In stock market news, Xero, the cloud-based accounting software firm whose shares have dropped 36% in the past year, has told the ASX it is in compliance with disclosure rules over its annual results, while criticising media reports that focused on earnings rather than metrics such as cash burn and revenue per user. The ASX sent Xero a please explain note on the heels of media criticism, asking how long before the annual results, which saw its net loss blow out by 96% to $69.5 million, had the company known about the deterioration. It also asked why hadn't it telegraphed that to the market sooner, given that the result was at variance with analyst forecasts. The ASX noted that Xero's shares closed at $20.32 Australian on April the 23rd, when the results were released, from $22.65 Australian the previous day. In answer, Xero told the ASX that it didn't consider the change in its net loss to be material because it was a software-as-a-service company in growth mode, meaning it was burning cash to build sales at the expense of profit. The company says, Xero is currently an early-stage, high-growth, loss-making software-as-a-service company that derives almost all of its revenue from a recurring revenue business model. Loss is less fundamental to the assessment of performance, as significant investment is required up front to attain customers and drive future revenues in order to adequately capitalise on the growth opportunity and recurring business model. Key indicators for Xero were trends in customer and revenue growth, cash burn rate, cash reserves, and the ability to fund growth. And metrics typically applied to software-as-a-service company, such as average revenue per user, costs of acquiring customers, annualized committed monthly revenue, and customer churn. The company says Xero's year-end cash balance of $269 million, which was 2.5% below the consensus of analyst estimates. It continues that also affecting the price of Xero's shares on the announcement day was the resignation of US-based Chief Financial Officer Douglas Jeffries and the fact that with limited liquidity, trading tended to be volatile.
NBR Radio with Snap. Work, play and live connected with Snap.
In economics news, an Australian economist says it's time to start reassessing bonds as safe havens, and they're now as risky as stocks, but his claims have come under fire from a macroeconomic market analyst. QUT senior economics lecturer Dr. David Willis says with Australian bond yields and inflation so low, Commonwealth bonds are no longer the safe bet they once were. He says, traditionally, bonds have had a safe and cushioning effect on portfolios when finance crisis and recession hit, as they're a reliable part of a diversified portfolio that also includes shares, corporate bonds and property. He says as the stock market crashes in a crisis and house prices fall, bonds have tended to be positive, but he warns that in the years following the global financial crisis, this has no longer been the case. Dr. Willis says, with bond yields so low and inflation low, there's now a real chance of bonds decreasing in value and a substantial capital loss. This makes bonds a similar risk to stocks, and he says investors should be taking a fresh look at their portfolios. He says the restarting of inflation and higher interest rates would see a capital loss on bonds. TD Securities Chief Asia-Pacific macro strategist Annette Beecher has rubbished Dr. Willis's claims, saying it sounds like he's just discovered what bonds are. Yes, yields are low and inflation is low, but it's all relative. She says investors who are content to have capital returned while earning a positive return will hold on to the bond until maturity, and if the price rises and falls in between, that's irrelevant. She says there is a risk, of course, of holding bonds while interest rates rise, but on most metrics, bonds are rich anyway. She continues, anyone with a fair value model would have the last 2 to 3 years of Australian Commonwealth government bonds and New Zealand government bonds trading well below. She says when rates in Australia normalise, so will bond yields. And that story from Jason Walls. In executive appointments news, Trilogy International, the skincare products and scented candle maker, has appointed its head of natural products, Angela Buglass, as its next chief executive, effective from July this year. Trilogy says Ms. Buglass joined the company last year after senior roles in the beauty and skincare industry at Estée Lauder and L'Oréal Group, and will take over the company's top job on July the 1st. Chairman Jeff Ross says her appointment is to support the company's growth in international markets. Mr. Ross says, with the New Zealand and Australian markets both performing well and profitably now, our strategy is around pursuing growth in our key international markets, including the UK, Asia and the United States. We've seen an opportunity to leverage Angela's direct, hands-on experience growing brands in these markets and feel she will now be best positioned to achieve this from the CEO's chair. Last month, the Auckland-based company forecast net profit to rise more than $4 million in the 12 months ended March the 31st, from $1.26 million a year earlier, with sales rising more than 18% to more than $35 million. Shares of Trilogy rose 1.1% to 95 cents and have gained 31% this year.
NBR Radio. Free to air online with business news you can use.